was a good week. Gains of the Dow and the S&P both over 2%, and the NASDAQ even higher.
Yeah, it's been a really interesting week. Some good news, of course, on the macroeconomic front, but I also think that investors are looking forward to earnings season. According to the way that I usually look at things, whenever the big banks, whenever they start announcing earnings, which happened on Friday morning, that kind of kicks things off. And so far, it looks like optimism is really running a little high.
We're going to look at earnings going forward, and of course, that is the big story as we go into the third quarter. However, we can't walk by what we've seen on inflation numbers. You know, a year ago, CPI was as high as 9%. In the most current reading, it's down to 3%. So there's no doubt that the Federal Reserve's aggressive rate hike has been working.
It has been, and I think that's a great observation, is to recognize that the Federal Reserve's, their rate hikes it hasn't just happened naturally, right? It has taken this effort by the Federal Reserve to do the aggressive path from basically 0% up above 5% for the federal funds rate. And when we got the Consumer Price Index number, which was for June, we can talk about that later on, the 0.158% unrounded month on month was pretty impressive. It took a lot of people by a pleasant surprise to say that inflation is on that long off ramp towards that 2% target.
So we saw a CPI number and, of course, PPI, which is Producer Price Index numbers this week, as well as a beige book. You and I spent some time off air talking about that beige book report.
Yeah, the beige book is a lot of fun. It was a lot more exciting than the color beige. But, you know, they used to print these things, and it actually did have a beige color to it, and they've just kind of kept that name. And it gives us anecdotes. There are 12 Federal Reserve districts, and each district, they really talk to business owners and bankers as to what's going on with economic conditions. 2 of those districts said that economic activity has declined, which is an early warning that maybe there is a recession beginning to brew, and it is so far fairly localized, but we have to watch, is that going to start to spread?
And we have watched that closely, but there's certainly a disconnect because you look at consumer sentiment, and that is going up, which is really hard to believe when you see all of this negative news.
Yeah, it was really hard to reconcile with that beige book saying that consumer activity is beginning to falter, but yet the University of Michigan's preliminary reading for consumer sentiment actually improved. We're back to where it was in September 2021, so coming out of COVID. During COVID, consumer sentiment was at a historic low, and then we got a really big bounce after the lockdowns ended, and we're back to that point. Now, we are still a far ways away from where we were pre-COVID, but it has been improving, even though consumers don't seem to really be doing that with their spending. They're actually slowing their spending, except for on leisure and hospitality. Yeah. That is the one area that they seem to refuse to give up on.
Yeah, they certainly are. They're outspending. And at the same time, we saw a spread, and we don't want to get too wonky here, but the spread between the 10-year Treasury and the 2-year Treasury was as wide as what we've seen in 40 years. And why that's important, it's usually a harbinger of a slowing economy, and that was incredible. That was a 40-year high just last week.
It was. Now, the interesting thing is we were anticipating that we were going to see historic lows as far as the spread between the 2-year and the 10-year all the way back in January. We did get a big negative number, but it got even more negative when it looked like the Federal Reserve was going to try to, what we would say, out-hawk the market. By hawk, that means that they are going to try to squawk a lot about hiking rates. And so you did see that massive inversion where the 2-year yield was much higher than the 10-year, but now it's begun to correct a little bit after we got those inflation numbers. So maybe the market is telling us the Fed doesn't have to go as far as what we originally feared.
And there is certainly a lot of squawking that's going to happen up until July 26th, because that is when the Fed meets. Highly likely that they will raise rates at that meeting, but we're going to listen to what they say afterwards on what the path could be going forward. And then, of course, if you stick around, we're going to talk about the earnings season that is just beginning and the opportunity set that's before us.